Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Emerging markets just been screaming, and the reason emerging markets have been screaming is a good reason. Number one, the Asian bloc emerging markets have been very, very undervalued in general because they've suppressed against China. Number two, the other emerging markets, because of the relative growth, the relatively high yield, the movement, the high commodity prices, the various growth opportunities in the stock market have driven these currencies up, and people are running offshore to get involved in the emerging market currencies because the developed world has very, very low interest rates and relatively low growth rates. So that makes sense. And we think it's a long-term structural thing, but near-term that will change too, or could change too, we think. This is the Brazilian real against the U.S. dollar. We quoted it this way to show that, so as this line goes up, the British real is increasing in value against the U.S. dollar. The red line on here are Brazilian stocks, and you can see how tightly correlated these emerging markets are to their stock markets. You see that generally in most emerging markets tied pretty closely their currencies to the stock markets, which makes sense because of the fact that, it's all a liquidity game. As liquidity flows into the country, drives the currency up, drives the stock markets up. Starting to see a little divergence in here. The stock markets in general starting to turn over in the emerging markets because they're finally starting to hike interest rates because of the inflation problems. But in general, we're seeing these moves. We've seen very, very big moves. You can see why Brazil is screaming about its currency. You can see how far it's gone. Brazil is a very interesting scenario because of its relationship with China. They used to love China, but now they're running a massive current account deficit with China, and China isn't budging its currency. So Brazil is now calling for China to increase its currency, and they're, although they're not friends with the U.S., their friendship with China is starting to fade in a big way. That's another area of contention. The emerging markets are finally starting to voice their concern with the Chinese currency being fixed where it is, and no matter what China says, they tend not to move it. Singapore dollar, this is U.S. dollar against the Singapore dollar. So as this line goes down, the relative value of the Singapore dollar goes up, and you can see this massive move in the Singapore dollar against the U.S. dollar, which I guess you would expect. One of our favorite currencies long term. We think this is going to continue to go, obviously, long term, because fundamentally these Asian bloc countries, again, on a long-term purchasing power parity basis, are really low compared to the industrialized world economies. If the U.S. dollar does turn, we want to quickly get into the Singapore dollar against the euro and pair it against there. Obviously, if the U.S. dollar falls off the cliff, we'd like to be in this. We don't know that. We just happen to think this has been a big, big move in here. We would like to see some of those negative U.S. dollar sentiment shaken out before we, build any positions in here against the U.S. dollar. We're just kind of taking it easy in here. But if you have a long-term bias and you can play with low leverage, the emerging market currencies, especially the Asian bloc currencies, are a place to be. We think you're going to have your problems, your ups and downs, your cyclical problems, but structurally we think they're going to be much higher going forward. This is a look at what we do, our newsletters. We have a free daily newsletter. We have a monthly. We have a daily currency professional. We have a new newsletter, Trading Commodities, commodity ETFs that John Ross does, and that's just come out. And you can find more information about that at our site right here. And that's it, Steve, and I'll take some questions if we have time.
Thanks, Jack. Very interesting, very informative, as always. So how can the attendees sign up for your free daily currency currents? Is it just at Black Swan Trading, Jack?
Yeah, just go to blackswantrading.com, thank you, and you'll see the currency currents listed there. And just click on it, and you can go in there and sign up. You can also get some free reports. We have several free reports in there that you can download. In fact, I think there's 3 free reports there that talk about these global macro type of situations, and also some of the way we look at long-term trading in currencies.
So there's a question, Jack. I guess the first, let's just get back to black swan trading for a second. So I guess the first thing is go for the free daily, if the attendees are interested, and then the currency currents professional. Is that the next step, or is it the investor, Jack?
It depends on what they do.
Normal process.
Yeah, if you're a long-term currency investor using ETFs and just want to know, just watch this global macro, kind of as I talked about here, we do that on a monthly basis in here. If you're a currency trader trading spot currency, and although we don't do much on the intraday at all, we're more position traders, and we tend to hold our currencies. But if you're a spot currency trader, it would be that right there. From an options standpoint, if you trade options, again, on a longer-term basis, currency options, and I think the ISC options are really good for that for the retail investor, because you know exactly what your risk is if you were just to buy a longer-term put or a longer-term call, make a leveraged bet on a currency. You can use the currency investor and the currency currents, because we talk of, you get a lot of free stuff in there about the global macro. So as an options trader, these 2 I think would actually be better.
Thanks, Jack. Tim has a question. His question is, what would be a good indicator to watch to determine when currencies is about to rise or fall? Jack, I know that's a very difficult question to answer, but what do you look at when you're looking for sort of a switch? You might be with the Big Mac Index. I know you're familiar with it. The fundamentals aside, and I know you spent a lot of time on fundamentals. How about technically, Jack?
Yeah, I mean those are everybody has a technical has a couple of technical things they say are just the perfect indicator. Nobody can call tops and bottoms. I mean that's just all there is to it. From a longer term fundamental basis, if the economy starts to improve and the relative interest yield starts to improve in a currency, if those 2 factors start to move in a currency's favor, and those are 2 things pretty easy to watch. You see the GDP improving, you see the yield improving on a relative basis in a country compared to other countries, which means it's going to tend to attract more money into it. Those are the 2 things on a longer term basis you can watch. On a technical basis, again, tough to find a top and bottom. What we do on the major currencies, and you're starting to see this offered in like the Mexican peso, New Zealand dollar, and some in the Russian ruble. If you go to the CME, you get the open interest numbers, and you don't have to track it daily. If you just track it on a weekly basis, go to the commodities, the COT, commitment of traders report for currencies. You see levels in there, and you see changes each week, bullish and bearish changes, and that's a good thumbnail for what speculators like and what they don't like. What we look for is high speculation in one way, expecting the speculator to be wrong, meaning a high spec open interest in one currency, very, very bullish, for example. And no magic here. It just means those that want to be in this trade, want to be long, are long. So there's not many people left to buy that currency. So if there's a hiccup or setback, it may or something that could change the trend. That high speculation, those one-way bets are good ways to give you another probability that something's going to turn. But as you know, Steve, there's no magic bullets here.
No, there's no magic bullet. No, you're right, Jack. But I like that. Great answer, commitment to traders. That is a great answer. Garth has a question about the earthquake in Japan and the potential for the Japanese needing their capital back. I guess I think he's referring to the money that they own, the U.S. Treasuries. Do you think the Chinese are going to continue to buy since the Japanese potentially selling Treasuries makes the U.S. vulnerable?
I think obviously they're going to need more funding, so they may rely on some of that, or at least that's what people have said in the market. And in general, when we've seen risk in Japan, we've generally seen repatriation from the institutional players and the retail players, pull money in from offshore into their savings, which tends to go into the short-term Japanese government bonds, very similar to what the U.S. happens in the U.S. when we see risk. People pull money in from offshore and move into the U.S. government bonds. So that process, the recent trade we've seen is probably more of expectations of a massive repatriation than the reality of it, although it's hard to tell how much has gone behind this. If you think of it from a global macro standpoint, if the U.S. starts to run or reduce the current account deficit with Japan, meaning the trade deficit starts to decline, and Japan takes treasury bills, sells treasuries in the U.S., those two will tend to balance, meaning if the trade starts to improve from the U.S., and we would expect it would, as the trade surplus in Japan declines because they need to be more internally focused, you're going to see the relative increase, relative balancing act. The U.S. won't need as many funds because it'll be running a better trade balance with Japan. So they'll tend to balance. So it's not a one-way street. So that's the way we look at it.
So the idea is that the U.S. is just going to have to consume less or manufacture more, one of those?
Well, not necessarily. By virtue of the fact that it trades more with Japan or sells more to Japan because of their current account surplus declines, and if they take that amount of treasury bills out of the U.S., then it's a wash. In effect, we won't need that funding, so to speak. So it tends to be a wash, so they do tend to balance. That's what global macro is good at. There's always got to be some balance around the world in these things. That's what we talked about. That's what I tried to talk about before. Not everybody can run a trade surplus in the world. There has to be somebody to take these exports, and then that's what's creating the currency tensions.
That does make sense, Jack. Let's see. Any other questions? Maybe one or two more. Jack's going to have to go. Garth has one other one. Why is it still considered developing? Excuse me, I was trying to read the question. I don't know, Jack. Is China really a developing country? Probably not, right? Or is it?
Oh, I'm sorry, Steve. What was the question?
I mean, why is China considered developing since it's so big already? We know the rate of growth is high.
Yeah. Well, if you break down, I think the easy answer is if you break down the numbers to the population, the net GDP per person in China, it's still very, very low compared to the developed world countries. So that's the way it's looked at it. And there's massive amount of rural areas in China that are incredibly underdeveloped. That farmers are just subsisting on it, barely being able to feed themselves. There's a massive amount of that going on. So although the size of the GDP is huge, if you break it down to GDP per person, they're still, they're in that developing world. They're not obviously emerging market. They are developing, but you can't compare them to a developed world country.
Jack, this will be the last question. Peter has a question. He says, so if the U.S. dollar rallies, which at some point it will, which will be the best currencies to trade against the dollar? So assuming that the dollar is going to rally, what would you want to short?
We want to short the euro. We want to short the euro because the euro and the dollar are mirror images, and if the dollar rallies, we think it's on a disappointment in Europe or a relative growth in the U.S. compared to Europe, and we think there's a lot of air in there. Obviously, we want to be also short the Japanese yen, short Japanese yen, U.S. dollar, long dollar yen on a longer-term basis. But on a trade basis, we think the euro is getting close. But then again, we've been saying that for a while, so it's tough to definitely. I do want to answer one more question, Steve.
Right. Trade prudently. Obviously, even though you've been wrong to some degree, you're still trading, which means that you got to manage your positions, not be too bullheaded, and not have massive amounts of money. I know that, Jack, you take your shots, but you're also managing your positions.
Yeah, that's what you got to do. Otherwise, you're just going to be gone. You can't load up, even if you like something. You can't completely load up, or you're going to be in trouble. And of course, we learned that by losing accounts, over the years, blowing out accounts to zero. So so you kind of learn that painful lesson, and you start to understand risk in your gut. So I want to answer this question, Steve, on the reserve currency status. It's a big one out there, and we've talked about this a while. That we don't think there's any way the U.S. is close to losing its reserve currency status, and one, because sadly there are no other alternatives out there, and if you think or you believe that China is close to taking over the status, I think you need to read the stuff written by Michael Pettis. I know Barry Eichengreen has come out and said the U.S. dollar could lose it in 10 years, but I think it's totally nonsense. If most people that are more reasoned, and I think he's trying to push his book, to tell you the truth, although he's very, very good, China has to make a massive change to the amount of assets they let international investors buy and hold in the country. They have to have a massive change in exporting capital as opposed to just importing capital. They have to make a massive cultural change in their economy in order to do this. Some people say if they do this faster than expected, by like 2020 they'll have like 5% of their currency, 5% of global holding of their currency, if it happens in a good way. The U.S. is currently held at about 65% denominated around the world as a reserve currency. The U.S. will, as the world changes and power shifts to the emerging markets, it will naturally lose its relative percentage as a reserve currency. But it's not something that just flicks on, flicks off overnight. Matter of fact, we've written a report on this, and you can go to our website, that says not in this lifetime are we going to lose it, because there's no other competitor. And when you think about, the dollar served the world pretty darn well when you think about it. And as much as we'd like to go back to a fixed rate system, the fixed rate type of system is very disadvantageous for the movement of global capital across borders. And we don't think that's going to change because globalization genie is out of the bottle. They're not all of a sudden going to start putting capital controls on all the major industrialized economies that are determined by the politicians. At least we don't think, because they can't really agree on anything. And number two, the gold standard, as much as we'd like to see that, it's just not politically viable in this market, because if you have a gold standard, you have to use your labor as kind of the flexibility rod in there in order to maintain your particular exchange rates. In terms of gold, you have to let your labor force just decline massively, meaning big deflations in labor and lower wage rates in order to bring in more capital. And in a world in which everybody's so compassionate, and that's just not going to happen either. So unfortunately, so this floating rate currency world is something we're stuck on, and I think it would work better if China kind of get off the horse, so to speak, and we would start if China would let their currency increase in value on a relative basis, we would see more normalized global trade, and so I don't think it's going to happen for a very, very long time. The SDRs that they talk about, special drawing rights from the IMF, is interesting, but again, that takes a massive amount of global cooperation. They couldn't even cooperate, the G20, on how to reduce some of these global imbalances in the near term. So I think I think this is really very much overplayed, and it's the type of talk you get as the dollar's in a bear market, and it will go away when the dollar starts to rise again.
Thanks, Jack. I want to give you just a moment for any closing comments you might have.
Yeah, I just want to just make the point that I think if you're from a global macro standpoint, just think of these linkages. If the U.S. Economy continues to chug along okay, we think China will be fine, and then the only wild card we think in the mix is what happens in the Eurozone. But this is the one to watch, and if we don't see a real problem here, the rest are in better shape.
Jack, thank you. As always, you give us tremendous insight into the currency markets, what's happening with the dollar, and please, I just want to remind everyone to go to blackswantrading.com to learn more about Black Swan Capital and everything that Jack and his son, they work together. They have lots of services, as Jack mentioned, so go to blackswantrading.com to learn more. Jack, thanks so much.
Well, thanks for having me, Steve. Thank you, everybody, for hanging on. I appreciate it. Great questions.
Take care, Jack. Have a great day. That was Jack Crooks. Just want to remind everyone, next week we have Price Healy. Jason Ayers will be the following week, and then Jeffrey Gibby and Ilian Yotov. So those are our next 4 guests. And if you're interested in ETF options, please join us. You can log right back in after this webinar, and Pro Market Advisors will be talking about trading ETF options. On behalf of the ISC, it's Steve Meisinger wishing you a safe and happy trading day tomorrow. I want to thank Jack Crooks again and Black Swan Capital for delivering such excellent material. Please join us again next week. Thanks again, Zoma. Thanks, Jack. And I want to thank all you, the attendees. Without you, the event doesn't occur. So thanks so much. Good night, everyone.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.